Thank you to all the media who've joined us today for this briefing. And the plan is to share the results of research conducted by the South African SME Fund, the SAVCA and Endeavour South Africa, which shows that local venture capital is delivering attractive returns to investors and contributing to job creation and financial inclusion. I'd like to introduce you to today's speakers. Their videos are on, so you should be able to have a good look at them, and then you'll be able to hear them. I've got Ketso Gordon, who's the CEO of the SA SME Fund, Claudia Manning, who's a principal at the SA SME Fund, Alison Collier, who's the MD at Endeavour South Africa, Anusha Naidu, who's the CEO of SAVCA, and Carl Westvig, who is the founder of Retail Capital and who exited to Time. Time acquired his business. Just some housekeeping before I hand over to the presenters. We intend keeping you here for an hour, that's all, because we know people are busy. Sandra, my colleague, is going to share the press release with you, which has embedded links to the 2 reports we're going to discuss today. She's going to pop those in the chat, and they will be emailed to all of you. She'll also put her details and mine in the chat. So if you'd like to interview anybody after this briefing, you can get in contact with us. We're also recording it. So if any of you want a copy of the recording, we can arrange that for you. So the way the program's going to work, I'm going to hand over to Ketso, who's going to explain why they did the research in the first place. Ali and Claudia will then take you through the research. Anusha is going to give you a perspective on from the overall ecosystem. And then Carl's going to give you a founder perspective. After that, we'll have a Q&A, and then we'll close and let you all go at 1:30. So thanks very much. I'd like to hand over to Ketso.
Thanks, Danny. So when you normally say venture capital, people think about Silicon Valley, and it's a valid thing to think about, because if you look at the New York Stock Exchange, 15, 20 years ago, it was General Motors and oil companies and big banks. And today it's Amazon and Facebook and Meta and all of the venture capital backed startups from 20 or 25 years ago. When we look at South Africa's venture capital industry, it's still in its very nascent stage, early days, but clearly has built a track record of some sort. We are in the business of trying to raise capital to allocate to venture capital funds. And one of the biggest challenges we've had in the last couple of years is persuading investors that this is a worthy asset class and it is the right thing to allocate a portion of your pension fund or institutional money to venture capital. And the main reason we wanted to do these studies was so that we can go back to both our current investors, but hopefully new investors, to persuade them that this is an asset class worth investing in. And that's the context in which the studies were done. We currently have 3.5 billion rands under management. We've allocated that capital to 20 venture capital funds. But if you compare us to the rest of Africa, we are roughly the same size as the venture capital industries in Kenya or Nigeria or in Egypt. But if you compare us to some of the big players, Silicon Valley probably invests between 9 and 12 a.m. what we invest in a year. So clearly a long way to go. But we are hopeful that with the presentation of these studies on our exit track record in South Africa, we can get a lot more capital. So let me hand over to Claudia Manning.
Thanks, Ketso. So we've been, as Ketso says, in the world of investing in as a fund of funds in managers now for over 8 years. And so in the environment in which we live, i.e. the managers that we've supported, we've been very impressed by the performance in terms of good investments that they've made, at good valuations holding up, some exits that have been done. But we realized that in order to genuinely make the case persuasively to institutional investors, we're going to need more than anecdotal data about the performance of the industry. So we commissioned these two pieces of work. The first one I'm going to speak about now, which is just about the numbers. What have we invested in venture capital over the last 10 or 15 years, and what have been the results from those? And then the second piece of work, which Alison will speak about, is about some of our really phenomenal companies that have done very well, either in terms of exit performance already or in terms of how they're doing and are poised to provide the kind of returns that we believe that investors are looking for. So let me speak about the first part, which is the quantitative study. So here we said, let's look at the data over the last 15 years. And we honestly didn't know exactly what the numbers were going to show. And we were very, very pleasantly surprised to see the data that is now sitting in your inboxes in the form of the study. So in summary, and I'll try and be quick about this, over the last 10 years, we've invested just over 16 billion rand into the venture capital asset class, into just over 1,000 companies. Most of that capital has been invested in the last 5 years, so from 21 onwards. And so if you think of the first 5 years, so sort of say, 2015 to 2020, we're looking at about 5.5 billion. And then we have double that in the last 5 years. So you're seeing an industry that we're seeing larger numbers going into investing in the industry in the last couple of years. And these are obviously younger companies that are still in the portfolio. They haven't been exited yet. Just to make the point that these numbers are excluding the angel investors, i.e., individuals who are investing, or also corporates. So this is fund managers who we interviewed, and we are fairly confident that we've captured the universe in South Africa of fund managers very well. What we found that was so very, very encouraging is that in these last 10 years, we've seen just over 200 of these companies have exited, i.e., the fund manager invested and then sold the portfolio, the company to another investor, and 60% of those made money. What was particularly encouraging for us to see, and the message that we'll certainly be talking to, we'll be spreading to other investors to get them to see the value of the asset class, is that the term that's used in the venture capital industry is money on invested capital. So it's how many times money did you make, and that number was more than 2 times. So we invested in these companies that made money. We invested about 2 billion rand of the 16. So that's 2 billion that was invested, and those companies were sold for just under 5 billion rand. So that's more than 2 times money. Now, there are different scenarios that we've painted. We've in terms of our data, we've not necessarily had full data for every single of these 226 companies. But at our most conservative estimate, there was at least 2.5 times money that was made by those investors. In reality, we suspect that the number is higher. Many people are quite anxious and not wanting to disclose the value at which they sold, just in case we all come knocking on their doors and ask them for a handout. And so therefore the numbers are likely to be higher than what we've quoted in the study. Just to give a quick point about how this compares. So Silicon Valley, as Ketso has said, is the sort of international benchmark. What we've found is that in comparing South Africa's performance, we are actually on par with the more developed venture capital markets around the world. The US, Europe, Latin America are all in the same kind of ballpark of around 2 times money. Clearly, there are a large number of the returns come from a smaller number of companies. That is the typical profile of venture capital. But the point is we're in line with, at least, or ahead of other comparator countries. So I mean, as I said, of the 16 billion that has been invested, more than 10 billion of that has been done in the last 5 years, which means that these are investments that are still sitting in companies, in venture capital companies' portfolios, and will be exited over time. And so we believe that the numbers going forward are going to be even better than what we've seen in the past. So we are very, very pleased to see that the numbers hold up against the promise that we've made to institutional investors, which is that you can make money out of venture capital. Okay, and I'm going to hand over now to Alison, who's going to give you a deep dive on some of our really well-performing companies.
Thanks so much, Claudia. So Alison and I head up the Endeavour team here in South Africa. And we've been in the market for the last 20 years and work with high growth entrepreneurs that are founded in South Africa and scaling globally. So just building on what Claudia is saying, to do this piece of research was really exciting for us to be able to put down such a solid fact base to show what the returns are of these high growth entrepreneurs. And so just to give an example, we looked at 20 businesses that exited successfully from over the last 10 years. And just to give you a flavor of who those businesses are, I would say about 50% of the ones that we looked at were in the fintech space, because in our South African entrepreneurial sector, about 50% of the businesses are fintech. And then we had a number of retail tech businesses and some reg tech and compliance businesses as well. And the names that you'll recognize, Retail Capital, so Carl is one of them. The other teams that were in the fintech space were PayFast, Luno, got Cash Connect, Ikorka. And then when we talk about some of the other categories, Isometrics is a team that works in the SaaS or compliance space, and then Rapid Deploy, which is more in the safety space. So there's a wide array of businesses that we looked at. And just to really confirm what Claudia was alluding to, what we saw sort of in between 2015 and 2020 was really just a handful of exits. So, somewhere between less than half of the number that what we saw between 2020 and 2023. So the number of exits, successful exits we've seen in South Africa in the VC space is more than 4 times in the early 2020s. And then I want to say that number we've seen close to double again over the last 2 or 3 years, which is fantastic to see that in the ecosystem. And this is also how these tech sectors grow. And I'm sure Carl will start explaining to that, because when you've got successful exits, then you've got founders who have generated a lot of capital from their successful business that they've built. But more importantly, they've got the know-how and the experience and the team to go and build the next business. And that's when it really gets exciting, because you see this being additive. So just building on that, why have we seen this fast-paced growth of the number of exits over the last 2 or 3 years, and then again 2 or 3 years before that? Between 2015 and 2020, the businesses that exited from this sector were all exited through to international companies. There was very little M&A activity that we saw from our local South African corporates buying these businesses. But that changed in the early 2020s. We saw then a number of South African corporates going in and purchasing and acquiring the fintechs and the other high growth tech businesses. And then more recently, in the last 2 or 3 years, we've seen evidence of IPOs. So Optasia listed on the JSE for 23.5 billion rand in the back end of last year. And then in addition to that, we've had quite a few secondary transactions that have been significant, well above, between 2 to 4 billion rand. And to have an active secondary market that's starting to develop is really important for getting the VC asset class going. And then just to talk about some of the numbers, well, when we look at the growth of these businesses and how additive they are to the economy, these businesses, they typically, out of the sample of 20 that we looked at, each of the businesses were employing at least 230 people in their teams. Over the last 5 years, these 20 teams added between 4,000 and 5,000 headcount to the employment in South Africa. And in addition to that, their revenue growth was close to 5 times over that 5-year period, growing at 256%. So it's extremely exciting to see the sector that's funded with private capital to deliver so much revenue and productivity growth as well as job creation in our market. And as the businesses get larger, they attract more international capital, and so we have more FDIs that come into our market. I'll leave some more of the numbers for you to look through in the report, but just the top line is, the typical size of exit that we're starting to see now ranges anywhere between 1 billion rand up to, I want to say, BVNK is the highest number, 30 billion, where the acquisition was made or was in the process of being made by MasterCard. But the average exit value is 1.6 billion, which is in rands, which is significant. And like Claudia was saying, the returns have been really strong that we've seen in the successful exits. And when we talk about a 54% IRR, which I want to say is, significantly higher than what you earn in the equity markets. So when you get these returns, when you get the investment correct in VC, you really generate a very significant commercial return for your investors, which I want to say we're really looking forward to see how the pension funds react to these figures and then come into VC in a more active way. And through that, we'll keep driving innovation. The other point I wanted to make on the profile of these businesses, and 50% of them being fintech, it's easier to use that category to explain, is not only are these businesses really innovative, but they're actually driving transformation in our country in a big way. And what do I mean by that? Well, if you look at the fintechs, I can use Retail Capital and Time Bank as a great example. They're significantly reducing the transaction costs, specifically for the low income and middle income South African, to access banking, and then also to access now credit. In addition, an example that went out, I think Time Bank shared it last week, they offer the highest return, like interest rate, on the money that you hold in Time Bank on a 1 month or 3 month or 3-year fixed deposit compared to the other banks. But the beauty is you only have to put 1 rand or 10 rand into your account. There's no minimum number that you have to put into your account. And we see similar things with, like, on Africa, when you're transferring money between markets, which on Africa does through mobile wallets, it's 40% cheaper to transfer money through mobile wallets versus transferring money, on a cash or a traditional basis. And when we're using these digital methods of payment in the fintech space, it really just means lower cost and more access. And that is so transformational for our market. So not only are these businesses driving productivity, but they're really making a huge difference to the bottom end of the bottom end of the pyramid here in South Africa, in addition to driving job creation and all the other good things that they do. With that, I'm going to hand over to Anusha from SAVCA just to take us through what the exit report means for the overall ecosystem and how it's evolving.
Great, thanks, Alison. So, hi everyone, I'm Anusha, the CEO of SAVCA. SAVCA is the industry body representing private capital in Southern Africa, which venture capital forms part of our bandwidth. So we're incredibly excited for the exits research to be able to promote the asset class of venture capital in Southern Africa. For us, as SAVCA's mandate, we look at being the ecosystem enabler.
Hi, Anusha, you're breaking up. Sorry. You've frozen.
International DFI.
Anusha, can you hear me? Anusha? Sorry, you're breaking up.
Sorry.
Ketso,
And I suggest we move to Carl and try and get
Yes.
Anusha off
yeah,
fixed up. Thanks.
Carl, please go ahead. We'll come back to you, Anusha. Sorry about that.
There we go.
There we go.
Lucy, thanks for the platform, and I recognize many of the team on the call today, so from previous lives. So, I mean, a quick summary on Retail Capital for those of you who don't know. So we kicked the business off in 2011, so call it 15 years ago. And it was essentially a model we brought from US, UK, which was changing the way of funding small businesses. And it was using a cash flow based model as opposed to a traditional asset based model. And it allowed particularly smaller retailers to access funding where they didn't have security. And what started off as a simple idea with a couple of agents running around visiting people, collecting data, has now grown into a business which is fully digital, online. It serves now, and Alison mentioned it earlier, it now does close on 4 billion rand a year of new advances to the small business industry, and serves about 50,000 new customers every year. So it's a significant investment into the South African community for business owners. We at 2022, December 22, sold the business into TymeBank. TymeBank at that stage was still in their growth curve of getting to profitability. And it was not just a financial transaction. It made sense for both parties in that the valuation our shareholders were expecting was below the valuation that could be achieved by TymeBank at the point. So it made financial sense, but it also allowed them to do a couple of things. So TymeBank then effectively inherited a lending capability. They had a team that had done this for, in some cases, 30 years. They could deploy deposits on their balance sheet into lending and create additional margin. And it just matured the whole organization all around. I mean, to the point where many of the Retail Capital executives stepped onto the TymeBank executive team and participated globally as well. So it was a bit of an acqui-hire, great financial transaction, and also leveraged what they had. And fortunately, along that road, we had the likes of the Future Growth, the CrossFins that invested in us. They gave us the capability. What was also critical for us was we went through COVID in the middle of it, which was potentially an existential crisis for us. Weren't sure we'd come out the other side. And we had patient shareholders, supportive shareholders, which is also critical in this ecosystem to make sure they walk the journey with you. It's not all smooth sailing as a venture capital business as you build, but we had high caliber, very supportive shareholders through the process. And when you come out the other side as a founder, I mean, I then spent the next 3.5 years inside TymeBank, helping build the infrastructure globally, etc., with a successful rebranding of the bank, with a new app that went live, with the Sanlam transaction. So there's been a lot of successes in the last 3.5 years within the TymeBank environment. So not only are you building a standalone business, you're building a capability, which extends much further. And I've been very fortunate to take the last 6 months off as a sabbatical, and I'm back with the batteries charged, climbing back into venture capital, funding myself. And ultimately, if you can build an ecosystem where there are funders at the table, you've got founders that become mentors and investors, you've got ecosystem players that can support how to build the infrastructure, it matures the environment. So, and added to, I think the big driver we're going to see coming forward in terms of more VCs and successes is AI. And not to belabor the AI issue, but the incumbents are more and more under threat because what they've built is going to become easier and easier to replicate, which means you're going to have more and more VCs that are adopting AI, that have no legacy, that are now going to compete with incumbents. And the incumbents either then have to partner, participate, buy, etc. So I think this flywheel that Alison mentioned is going to get bigger and bigger and bigger and faster and faster. Thank you.
Thanks, Carl. Carl, I'm going to hand across to Anusha now. Anusha, can we try again with you? You might want to
Yeah.
turn your screen off, and at least we can hear you.
Okay, great. Thanks,
Thank you.
everyone. Hopefully this is better now. So SAVCA is the industry body for private capital. We look at ourselves as being the ecosystem enabler and looking at asset class promotion to potential investors, which include pension fund trustees, international DFIs, and institutional investors. So this research is incredibly insightful and very exciting for us as the ecosystem enabler. Often we spend time with pension fund trustees, giving them training and capacity building, and giving them key stats in the VC and private capital ecosystem. So this research really gives us incredible data and rich data sets to actually use to provide that training. And we're incredibly grateful that the funds, the portfolio companies have all actually been incredibly generous with providing the data and the research to provide such meaningful contributions. For us, exits are incredibly important. It delivers returns and recycled capital in the ecosystem. And we're very, very excited about what the research actually provides. In terms of Reg 28, current allocation looks at about 15% to private capital, but we note that this is still quite a very limited source of pension fund allocation. So this research also provides the impetus for pension funds to deploy more capital into the VC ecosystem and making sure that pension fund returns are quite diversified and enabling job creation, employment, innovation, etc. So yeah, very excited about the research. That's it from me.
Thanks, Anusha. And thanks to all of our speakers. So I'm going to open it up to a Q&A from the journalists who've joined us here today. If you want to ask a question, please just put on your camera. You can maybe raise your hand and say where you're from, and please go ahead and ask your question. You're also welcome to pop them in the chat, and we can ask the questions on your behalf. I'm just going to monitor the chat.
Okay, maybe I can just share one or two sort of trends that we've seen while we haven't got any questions, and it's been just on the more recent exits. I'm going to use the example of Rapid Deploy. So Rapid Deploy is a response SaaS solution that basically who's the customer? The customer, the US emergency response 911. And then the hospitals and ambulances, as well as other emergency services. So Rapid Deploy was sold through to Motorola in the US. But why I want to use that example is that it highlights the really exceptional talent that we've got in South Africa. So what we see that we have in South Africa are really highly skilled individuals in this tech space, getting more and more experience as the high growth tech sector is evolving. But what was really exciting was, yes, they were bought by Motorola, but every single person in their tech team was kept and maintained on the team even after the purchase, and that team is still now working, as Rapid Deploy, but part of Motorola. Out of their offices are in Cape Town, in quite close to the waterfront, and then a few other parts of South Africa. But it's really, we're seeing more and more of this trend that yes, the businesses are exited, but the team, even when it's purchased through an international M&A transaction, the team majority of the team remains intact, based in South Africa, and continues to work in the newly acquired business. And I want to say for us as South Africa, as a market for tech talent, that's really wonderful news. So I don't know if there are any questions yet, but
I think Michael Avery's got a question. Michael?
Yeah, thanks so much. I think really interesting research, still kind of pouring through it, but just at a headline level, that 2 to 2.5 times money realized sounds impressive. Do you have the figure kind of net of fees, after fees? What did the LPs receive after fees and carry?
Michael, we haven't done the calculation sort of net of fees, but I mean, it's not like, I mean, we'll have to come back to you on that. We'll see if we can do a rough estimate and come back to you.
Well, I mean, it would strike me that that's what pension funds would want to know, if you're going to use this as evidence to institutional investors, that want that figure. Maybe just one follow-up. Yeah.
I mean, you know, typically managers get 2% fees, and they share after investors get their money back. They take 20% of the profits. So, you know, it is clear that 80% of the profits that were made after returning capital would go back to the original investors.
What would you say has been the biggest breakthrough to help realize more exits in VC? Is it domestic M&A? Is it international? Is there a trend that you're picking up there that maybe some of the bigger acquirers or banks or insurers looking at these technology businesses are finally accepting that their own innovation machinery is maybe often a bit too slow, and buying the company is the more rational option here?
Maybe just as a first comment on that, and this is really broad brushstrokes, so just also take it like that, is what significantly changed in the last 4 or 5 years is how the banks in South Africa have got more involved with actively M&A. And I think it's two-sided. As a large organization, you can't buy a business that's very small. You have to buy a medium-sized business for it to make a meaningful change to your organization. So, you know, or else you're buying, you know, something that's very niche, and then you can purchase it when the tech business is quite small. So it's been sort of two sides. One, I mean, I hear your point on innovation, and yes, it's much easier to innovate outside than inside. So yes, that's very true. But that being said, the fintechs are now at the right size and stage that they're big enough to be attractive investments for the banks. And yes, it is. It definitely, if you can integrate after you've bought, that's definitely a cheaper way to do your innovation. But you know, there's the cost of integration once you've made an acquisition, which does need to also be taken into account, which will be key for the larger businesses to be really good at to make this work. So yeah.
Alison, maybe I can add to Michael's question. So I can speak from experience that we've certainly seen where the banks have been very monolithic in the past and decided they can do it all themselves. And in some cases have bought sort of tiny stakes to learn the model and do it in-house anyway. That's shifting. So we're certainly seeing more JVs happening, more acquisitions happening. Ikorka went to Nedbank, which is sort of the genesis of the SME banking platforms, as much as they're ready to acquiring. There's a partnership, I think it's public, I know it's public, between the Retail Capital actually and FNB, and FNB traditionally haven't partnered a lot in the past. So there's certainly a changing momentum in the banking space where they're adopting fintech.
Thanks, Carl. Michael, does that answer your question sufficiently?
Yeah.
Okay.
No, it does. It does. Thank you.
Sibahle, you've got a question?
Hi, yes. I'm not sure if I'm unmuted yet. Can you hear me?
Yeah, we can hear you perfectly. Thanks. You're from IT Web, Sibahle, is that right?
That's correct, yes. Thanks so much for an insightful discussion. I just wanted to find out more about the area where VCs are increasingly adopting AI. What phase of adoption are they in? You know, was it the early phases or maybe the later phases? And also, what are those functions that VCs are increasingly adopting AI to conduct within their operations? Thanks, that's all.
Who's happy to answer that question?
I'm happy to pick it up as a practitioner more than anything else. So, I mean, obviously AI, we talk about AI today with its current maturity, but a year ago it was a fraction of what it is today. So it's a very fast evolving space. The newer the business, the more likely they are to be fully AI native. The older businesses are obviously more likely to be using AI for productivity gains as opposed to changing the way they do business. But we certainly are seeing many of the VCs going, if I could use the tools today, it's a bit like when the internet came on and when mobile phones arrived. It's a whole new paradigm on how you build your business, how you think about your business, the data you support, the intelligence you create. So it's a very fast moving space, Sebastian. It's I think everybody, if you ask them today, you'll have a different answer in a month's time.
And just to add that in the portfolio of the fund managers that we've backed, there are a number of AI native companies that are working on solving customers' problems using AI. I mean, there's one based in Stellenbosch that cannot hire data scientists fast enough. As the universities produce them, they hire them. And so we're, as Carl says, we're expecting to see more and more of these startups coming into our portfolios.
You happy, Sabahle? Anything else?
Yes, thank you so much. That's it for me.
No problem. Stuart, I see you've got a question.
Yeah, I just wanted to know whether you are involved in the informal sector at all, in investing in businesses in what we call the informal sector, in townships, the commercial businesses and many transport businesses that are rapidly becoming quite significant businesses. So I just was wondering about that.
I'll take that. We've done two different things. I mean, there's a lot more activity in the lending space within the township economy. So lending via spaza shops for improving their ability to purchase larger orders at a more reduced price. So providing much needed working capital. And then there's one that does really interesting work in building backroom housing in townships for rental to others, called Ingloo Living. And they recently announced a big deal with RMB after being able to prove that they could scale their model. When we first allocated capital to them, they had a book of 25 million, and now it's probably above 1 billion. So that's on the debt side. On the equity side, we've definitely seen two things happening quite a lot. One is supporting spaza shops and making available the ability to buy smaller quantities electronically from shops. So distribution improvements, but we've also seen a lot of last mile distribution within the township being sponsored by renewable energy vehicles and others. So those are the kinds of things we've seen, not much else at the moment.
No, I want to say, in addition to that, the whole digital payments piece, like what Ozo, what Peach Payment, and Stitch, those businesses provide, are the primary users of the digital payments are individuals who are living in informal markets. So, and that's all about, you can just, get your SASSA grant through a digital payment rather than having to go and stand in a queue, is one example. Or you can pay someone or receive money from someone, someone in your family who's assisting you with your monthly living expenses digitally now rather than through cash. So I want to say the bulk of the fintech businesses that have been built in South Africa, more than 50% of their customer base is informal market or the lower income group in South Africa, for sure. Ketso has explained fully through the credit. And then in addition, we're getting some businesses working on security. So Aura, for example, similar to what I explained with Rapid Deploy, but Aura, you as a individual who's, spaza shop or owner or someone in the township, you press your Aura Rapid Response and you get response from private security, and it's not in every single informal area yet, but it's around the big metros. That's what's happening, and it's wonderful complementary service to the police. There are different mechanisms with how the payments linked up with insurance or through who you work for in the corporate world, but it's there. I would say majority going back to it of the fintech offerings are all for individuals in lower income or in the more informal market.
Just to add, if you look at the announcement yesterday today around Flash and Shop to Shop, they might not have been fully VC funded, but they're fairly new businesses that do substantial volumes in the township areas. I think they're doing about 200 billion a year in turnover. It's monstrous.
That was a great question, Stuart. Thank you very much. We've done a bit of work with the SME Fund and spending some time with some of these businesses that they've just mentioned, and it's really extraordinary to see how they work on the ground. So I'd really encourage any of the media here who want to talk to any of those businesses in depth to just to ask us, and we can help put you in contact with them, because I think they've got good stories to tell as well. Skulk from Engineering News, you've got a question. Then I think Lindsay from Daily Maverick. Skulk's question is, at what stage of technology development can VC help to support emerging technologies such as green hydrogen or green steel production? Who's going to take that one?
Ketso is.
Ketso.
The sort of the generic answer, although there's specific stuff happening in the hydrogen energy space, is that initial investment has to be done by government in the raw research that goes into the producing the IP, producing the knowledge, and that is happening. So our universities collectively at the moment spend north of 20 billion rands a year on primary research. So that's the first source of knowledge. The second is that we have a really impressive array of science councils. So the CSIR is probably the most well-known, but we have 7 of those in the country, and they generate a significant amount of knowledge. Again, if you add up the total amount invested in research through the science councils, it's another 10 billion. So there's a lot of knowledge coming out at a raw knowledge level. And what needs to happen with that is that the ideas need to be commercialized. So we work with universities, other people work with science councils, to try and begin the commercialization process. And it can start very early when it's still an idea and needs capital for testing the product or doing research, further research, or beginning to execute a model or doing a small scale experiment to prove whether the knowledge and technology actually works. So we call that technology development funding. Some of it comes from government, some of it comes from private individuals, some of it comes from corporates. But from that point onwards, it really does become a venture capital thing, providing seed capital and providing growth capital. So the thing I want to refer to is one of our funds is called the University Technology Fund. We established it 7 or 8 years ago. It's now in Fund 2, and it has partnered with many universities to help them commercialize their IP. And I think it's a route that's well trodden in the developed markets, huge room for improvement in South Africa. So when we talk about growing the asset class, that's obviously one of the subsectors we want to put a lot of time and money into.
Thanks, Ketso. And I think UTF just closed their latest fund, didn't they, Ketso?
They've got north of 400 million to invest into new startups.
Yeah, so Skulk, if you want to speak to the guys at UTF, if that interests you, let us know. Lindsay? Lindsay, you want to put your mic on? Please go ahead and ask your question. Okay. Well, you can pop it in the chat if that's not working. Okay.
Hello, is that working?
Yes, there we go. We can hear you beautifully. Go for it.
Cool. Sorry about that.
No problem.
Now that we're seeing more Southern African startups succeeding on a global stage, like how is that day after the exit changing the mindset of new founders? Because VCs are pretty much like incentivizing, thinking of like global buyouts as the new normal and moving away from local problems. So is that something that we are seeing as a culture?
Ali?
Yeah, so I mean, what we're seeing as, you know, what businesses are being built here in South Africa are definitely businesses that are solving real mass market problems for South Africans that can be tweaked and then also, you know, expanded to customer bases elsewhere. Or else you could say the same, but for South African corporates, and then selling through to South African corporates. But so are bigger checks written by MasterCard and Visa, you know, if we're talking fintech, than the local banks? I would say, you know, yes, because Visa and MasterCard have got a much bigger balance sheet to make those acquisitions, you know, to make those acquisitions, and a much bigger global market that they're working with already to then, you know, scale that business to. So therefore they're willing to pay more. But I do want to say, I mean, the recent acquisitions we've seen in fintech have been primarily outside of one or two through the local banks. And, you know, retail capital being sold through to GoTime is one example. Carl mentioned another example of iKhokha being sold through to Nedbank. We had WalletDoc sold through to Capitec. So we're actually seeing an acceleration or significant growth of local M&A activity to complement the international M&A activity. So, I mean, yes, you know, South African entrepreneurs are building businesses that we bought, you know, by our local banks or by international banks, and, you know, just depends on, you know, which option is going to work best for the founding team, who they choose to exit to. So it's wonderful to have these choices. And I want to say 10 years ago, as South African entrepreneurs, you typically were forced to sell through to international businesses, because those really were the only teams who were looking to acquire. Now we're seeing many more local corporates looking to acquire, both in fintech and other sectors.
You want to go first,
Anusha?
Anusha?
Thank you.
Yeah, just
Anusha,
to
you
come
wanted
in
to add
here.
something? Yeah.
Yeah, I just wanted to also add that the pathways to exit are also diversifying. It's not just a one size fits all. It's international M&A, it's domestic M&A, it's secondaries. So it really is the industry moving into early stages of maturity, where you've got these different pathways for exits.
And speaking as a founder, so what's pleasing to see in the last couple of years is how the founders are also shifting their focus. South Africa is a great proving ground, but they're also looking to adopt global expansion. And not just, I mean, African is obviously a natural corridor for us, but to be able to go east, to go west, to go to the US. So there's lots of expansion, and the mindset has shifted to take on bigger problems and bigger markets, which is good for everybody.
Thank you.
I don't see any more questions right now, but I just, so sort of heading up to before we close, I wondered whether any of our speakers just had some last thoughts that they'd like to share with you. I mean, really, maybe what was the real final takeout of the reports for you? Do you want to start maybe with Ketso?
Yeah, I mean, it's not so much on the exits, but I think what we've seen in VC as an ecosystem is the period up to 2020, you know, maybe 4 to 5 billion invested. We've seen that number double in the last 5 to 6 years. And our expectation fully is that number is going to double in the next 5 years. You know, as the SME Fund, we plan to raise a 2 billion rand fund in the coming year, which we hope will be invested in by a large number of other people and LPs and institutional investors, so that our funds that we invest in will raise a total of about 10 billion. And we are just one of the larger players, but we are one of many players in the market. So we definitely see a trajectory where every 5 years the VC market will double in size, at least for the foreseeable future. That has huge implications for exits, because our current portfolio is maturing nicely. We will see some amazing exits in the next 3 or 4 years from our existing portfolio, but it just increases the scope for more amazing stories. And I think that the exit studies we've done now need to be repeated every 5 years, so that we can go back to investors and confirm the story that VC is an asset class worth investing in. Thanks.
On that very optimistic note, Ali, do you want to add anything?
Yeah, I mean, just building on what Ketso was saying. Yeah, so we've seen the VC asset class like double every 3 to 5 years. We're seeing the exits grow by sort of 4 or 5 times every, in decreasing number of years. So that's happened in the last 2 years, and again in the last 2 years before that, prior to the 5 years before that. And we know that these businesses grow their revenue typically at around 50% a year. And then in addition, their job creation is running at about 20% a year, if not sometimes higher. And back to the question, most of the customers of these businesses are lower income, South Africa, and then also, likewise for other markets. So it's just, and it's all funded by private capital. So it's just such a wonderful sector for South Africa and for South Africa's economy and the growth that this sector can then deliver. And I want to say, Carl, we're looking for more teams like Retail Capital to exit and do more things. And I want to say we've got now a fair number of really successful exits that have happened in the last 10 years. And those teams are still here in South Africa and building their next businesses. And that's really where you see the ecosystem and the economy start moving. So excited for that.
Claudia, anything to add?
Sure. So up until, well, actually for the last 8 years, up until now, the SME Fund has been the single largest institutional investor into VC. Not because we had an enormous amount of money, but because there was so little other money coming into, from large investors coming into the asset class. And what's been very encouraging just in the last 2 or 3 years is that if you look at the new investors, the investors who have decided that it's worthwhile considering putting money into VC, that number's growing. So if you look at, Sanlam, Standard Bank, RMB, Allan Gray, Future Growth, a number of these bigger institutions that have up until now not necessarily been, very keen on what has been perceived as an asset class that's not necessarily recognized as worthy of receiving institutional investment, that's changing. And so we're very optimistic that as the data on how strong the performance of the sector is, gets out and is discussed and widely shared, that we'll see more of that happening going forward.
Thanks, Claudia. Anusha?
Yeah, so from my perspective, it's been really incredible to see the richness of the data, to see the fund managers provide the data sets as well as the portfolio companies. Private markets, we don't have a Bloomberg, if you will. So it is very important for us to be able to get this data set and be able to demonstrate what the returns look like. And provide like a benchmark in terms of what we are seeing in the industry. For me as well, what's incredibly promising is the more institutional investors that are interested in this asset class, wanting to sit in on trainings and conferences and engage a lot more in the VC architecture. So I think that's incredibly promising because we need to have more allocation into the space and more questions, more understanding. It's not just about risk. It's about understanding what the portfolio can actually do to enhance returns in a diversified portfolio.
Thanks, Anusha. And Carl, I'm going to leave the last word for you because you're the one who's really been in the trenches here.
So it's easy to talk about returns. What we need to figure out is what does the risk look like as well and how do we mitigate that. And what I'm seeing is a maturing ecosystem, which means there are more founders, there are more mentors, there are more advisors, there are more support bodies, there's more support coming from the funders like the SA SME Fund and the endeavors. They create amazing forums and the work that Anusha does at SAVCA. So people are learning from each other all the time. What are the models? What to watch out for? What are the pitfalls? How to access more capital? And as it matures, you actually reduce the risk on these VCs. So you're going to see the returns growing and you're going to see the risk coming down. So it's an asset class that's going to keep proving itself in the future.
Thanks very much. Okay. So all of you should have a copy of the press release and a link to the reports You should have Sandra's and my contact details if you've got any questions or like to set up any interviews with any of the speakers. And I'd just like to really thank our speakers today for joining us and to the media. And I'm going to let you all go and get some lunch.
Thanks, everybody.
Thanks, everyone.
Bye.
Thanks,
Thanks.
everyone.
Bye.
Great to speak.
Bye-bye.